This week featured two significant events. We broke out of the symmetrical triangle we've been in since the correction began in late January, and we had a clear example of how new information can move the market. We'll start with a look at how the market discounts news, concerns, and geopolitical events, and then we'll look at a pattern that may unfold in the market in the weeks and months ahead. This quote is a good place for us to begin as we look at how news is priced by the market. There are thousands of companies listed on U.S. exchanges. The S&P 500 is used as a benchmark by professional investors. We can buy a share of the S&P 500 index by buying an ETF called the SPY. The SPY mirrors the performance of all 500 companies in the S&P. The index contains companies like JP Morgan to Google, Amazon to Berkshire Hathaway, Apple, and Microsoft. The performance of the SPY represents the performance of the stock market as a whole. So what moves the price of the stock market and the value of our investments? What causes price to go up and what causes price to go down? Every day, billions of shares are traded in the U.S. markets alone. The transactions in which these shares are traded represent the agreed-upon price that hundreds of millions of market participants around the world decide a share of stock is worth. Each agreed-upon price requires a buyer and a seller. A buyer offers a bid price that they are willing to pay. A seller asks a price that they are willing to accept. The accuracy of the market pricing comes from agreement and consensus among hundreds and millions of buyers and sellers. No matter what a buyer or seller thinks a stock is worth, a transaction can only take place when buyers and sellers agree on price. The price at which a buyer and seller agree to trade shares becomes the current market price. The price at which the last trade of the day takes place becomes the closing price. This is the most important price. We went through this slide in last week's video. To summarize, there are only three ways price can move from day to day: up, down, or sideways. These movements are determined by the balance of buyers and sellers' expectations about the prospects for their investments. These expectations become the basis for the familiar concept of supply and demand. On daily time frames, when the expectations of risk and reward between buyers and sellers are roughly balanced, we have sideways or range-bound movement in price. At any time, there's a balance of positives and negatives affecting the market. Examples of reasons to buy currently in the news include economic growth, tax reform, regulatory reform, earnings growth, and strong employment. Any issue or concern that you can possibly think of is being weighed by all market participants and is reflected in the current market price. When the majority see reasons to buy, there is more demand from buyers than supply from sellers, and price rises. Conversely, reasons to sell may dominate the market, and these might include high valuations, North Korea, Iran, trade wars, and a flattening yield curve. Again, any issue or concern that you can possibly think of is being weighed by all market participants and is reflected in the transaction price, or the current market price, at which shares trade hands. When the majority see reasons to sell, there is more supply from sellers than demand from buyers, and price declines. All news, concerns, and methods of analysis used by investors are reflected in the prices agreed to by all market participants. These include fundamental analysis, macroeconomics, geopolitical risks, noise from the decisions of individual investors, and technical analysis. Price is what appears on our statements as the value of our investments, not PE ratios, price to book, or any other value. Price is what pays. Technical analysis is the study of price. Price reflects the net bullish or bearish opinion on all issues presently seen by every market participant. The market sees all transactions. To give you an idea of how rapidly the market reprices or discounts new information, here's a chart of the S&P ETF, the SPY, from Monday, May 8th. This is a 5-minute chart. At 2:44 p.m., Trump tweeted that he would announce his decision on the Iran nuclear deal on May 9th at 2 p.m. This was much earlier than the market was expecting his decision. Within 20 minutes, the market discounted the new information and dropped by 0.7%. Price was reset by the decisions of millions of people determining at which price to buy and sell shares. Technical analysis is the study of price. Market price is the best measure of the current intrinsic value of an asset. Technical analysis is based on two of Charles Dow's observations. First, that the market discounts every factor that may influence a security's price. Second, that market movements are not random and move in patterns and trends that repeat themselves over time. As we say often, we don't use technical analysis to predict. No one can predict the market, but price movement can tell us about probabilities of future price movement. You know this from your own experience looking at graphs that you see every day. If I show you this graph of the S&P from 2014 through 2016, you see that price emerged from a sideways consolidation and began to go up. You would guess that after such a long period in a range, price would most likely continue to go up. You would probably also think that price had a much lower probability of going down like this. If your experience told you that price would continue to go up, you were correct. Price continued to climb throughout 2017. Technical analysis uses evidence to determine probable outcomes. It's human nature to want an explanation for what happens in chaotic markets. We want a magic formula that describes order. Human nature, on the other hand, is quite predictable. There's a tendency to read into headlines and buy or sell on hopes or fears versus responding to the facts the market is giving us in price. More money has been lost in predicting recessions and collapses than in all actual depressions combined. Now we'll shift to long-term patterns in the market and how they might unfold in the weeks and months ahead. This is a chart of the S&P from 1925 to early February 2018. You can see that the upper and lower yellow lines form a channel. You can also see that there's a smaller channel between the red and green lines within the main channel. I want you to focus on the red line. Notice that this line has served as support for price in 1999 and 2001, and then price broke through support. The red line served as resistance in 2002, late 2007, and now in 2018. The more times a line of resistance is tested, the more likely price will break above it. Zooming in, here's our familiar monthly chart of the S&P from 1996 through 2018. Note we'll be using the SPY ETF in the next several charts, which is the buyable form of the S&P 500 index. We see our long period of sideways movement that includes the dot-com bust and the global financial crisis. Price moves definitively above the range in 2013. We see a fractal pattern of correction from 2014 through 2016, which brings us to the present 2018 correction. We'll zoom in on this area here from 2014 to present. Looking more closely at recent months, price rose steadily through 2017. At the start of 2018 in January, there was a tremendous influx of demand from buyers, which pushed price up rapidly. When demand was saturated, there was a lack of new buyers coming in, and supply from sellers pushed price down, starting the correction. The market often has to digest large gains through time and price. The gains from 2016 through early 2018 are being digested in the current correction. In February, sellers pushed price all the way down to 252.92, at which point prices became attractive enough to generate demand from buyers, who pushed price back up to 270.57. In March, buyers showed continued demand driving price up, but they wouldn't pay prices above the top of the range. Now we'll talk about time frame continuity, or continuous direction of price across time frames. In April, price remained inside of February's candle, here. Note that the April candle is white, meaning that the direction of price was up. May's candle is highlighted in yellow because the month isn't over yet. The bottom of the May candle shows that price made a higher low, and the white color shows that price continued to move up. The shape of the candle is bullish, but again, the month is far from over. We would like to see a continued rise in price through the end of the month, but we trade what is and not what we would like to see. The weekly chart of the SPY shows that we broke above the symmetrical pattern of the correction. An area of potential overhead resistance to advancing price ranges from 273 to 274. You can also see that there's a channel on the weekly chart composed of a green support line and an overhead red resistance line. Since we're saying that historical patterns can tell us something about probable outcomes, let's review the chart of the VIX from our April 25th video. The VIX is Wall Street's fear gauge. When investors are concerned about stock market declines, they buy puts on the S&P 500 to protect against declines. Remember that bull markets are born on pessimism. When pessimism peaks, we run out of sellers, and demand from buyers outstrips supply, causing prices to rise. A rise in the VIX reflects pessimism. When the VIX spikes and then falls, the stock market rises. In the April 25th video, we noted the descending triangle pattern shown in gold. We said that price typically breaks below a descending triangle. So how did the probabilities play out? Looking at the current chart, indeed price did break below the triangle, and the S&P has been moving higher. In a minute, we're going to look at daily charts of the S&P. But before we do, we're going to review two price-based indicators that we're adding to the charts. First, we're going to show moving averages, which are simply a moving average of price over a defined period of time, such as a moving average of price over a period of 5 days. The average is called a moving average because it forms a line where any point on the line represents the average of the previous rolling 5-day period. Moving averages smooth daily fluctuations in price, shown on this candlestick chart, into a smoothed moving average line like the 5-day moving average on this chart. The moving average period that represents the line is noted on the chart legend. The second element that we'll add is the Fibonacci ratio or golden ratio. This mathematical ratio appears throughout nature, the design of our own bodies, our artwork, and even price behavior in the markets. Traders use these ratios on charts, and whether a naturally occurring phenomenon or a self-fulfilling prophecy, price often gravitates to Fibonacci levels as support or resistance, as you'll see. So before we add these two elements, here's our daily chart of the S&P from last week's video. We mentioned that 2650 was a key level to clear in the S&P. The price of the SPY is priced at 1/10 of the S&P index value, so the level we'll be looking for in the SPY is 265. Let's look at the current daily chart and start with the moving averages. We see the 50-day moving average line shown in blue, and we show the 200-day moving average shown in red. We see that early in the correction, price struggled to stay above the 50-day moving average, slipping back below it each time it cleared it. The 50-day moving average was serving more as a level of resistance than support. Once prior resistance is decisively broken through, it often becomes support. Current price is back above the 50-day. Looking at the 200-day moving average, you can see that the 200-day moving average served as support, with price testing the moving average multiple times. Support held, and price has now begun moving up. The Fibonacci ratios have also been added to this chart, and they are shown in blue. These are ratios of the distance that price has traveled from the peak in late January to the trough of the correction on February the 9th. We're going to highlight 3 of these Fibonacci ratios that are important for the week ahead. This area is the 50% retracement level and may serve as an area of support when price pulls back. The 265 level that we said was important to clear last week coincides with the 38.2% Fibonacci retracement. The 61.8% Fibonacci retracement is currently serving as resistance to price. As we've mentioned, price can only move up, down, or sideways. This is the foundation for a charting technique using inverted triangles that show potential boundaries of future price movement. Focusing on the left side is by definition focusing on the past. Focusing on the right side in green starting with today is how you chart future price discovery. Price moves diagonally up or down in a series of inverted triangles. As price breaks up or down out of an inverted triangle, a new expanding inverted triangle of price discovery is formed. Using this technique, let's look at the week ahead. Bringing our charting technique and price indicators all together, we see the inverted triangle that price is currently in as of 1:42 on Friday. To get to this point here, we've expended quite a bit of energy since the test of the 200-day moving average here. I would fully expect that next week we'll go back and retest some prior levels of resistance to see if they become support. Overhead, we have lines of resistance, including the 61.8% Fibonacci retracement and the red upper boundary of the inverted triangle. We see lines of support, including the lower boundary of the current inverted triangle, and this line has not been retested yet to be confirmed as support. The green horizontal area shows an area that has served as prior resistance in the past and now may serve as support. Again, we've expended considerable energy to get here and will likely backtest early to the middle of next week. Looking further ahead, patterns that take months to resolve often give us a rare opportunity for determining probabilities on much longer time frames. Here is a daily chart showing the symmetrical triangle that we entered in late January and exited this week. This is a commonly studied pattern in technical analysis from which we can derive future price targets. Notice that we touch the upper part of the triangle that served as resistance at these 3 points. The lower part of the triangle served as support at these 3 points. The width of the top to the bottom of the triangle was 33 points on the S&P. We used the width of 33 points to set the price target on exit. For the price target, we add 33 points from the exit at 270. We also add a resistance line in red that runs parallel to the lower leg of the triangle. Here's the potential path to our target using the seasonal trend in S&P futures over the past 30 years. History seldom repeats, but it often rhymes. So remember, this is just an example. We're not focused on the day-to-day path. We're focused on the probabilities for the coming weeks and months. Using this path, we get to an approximate target in the neighborhood of 300 sometime in late September. It's helpful to monitor the trend strength of the market. Now let's look at how we use this from a practical perspective to construct investment portfolios. The strength of the overall trend serves as the basis for our decisions around portfolio construction. We monitor the trend strength of the market, and then we determine allocation to growth or defensive assets based on the strength of the trend. We compare the relative strength of various sectors to the S&P 500 to determine which sectors to invest in. We select sectors that are or have potential to outperform the market. The model that we use to gauge the strength of the overall market has 5 submodels: a long-term trend strength model, an economic indicators model, a liquidity model, a technical model, and a risk model. The combined outputs of these 5 submodels gives us an overall market score that tells us about the strength of the trend. The score of the market's trend strength from our model ranges from 0 to 100, 0 being the most bearish to 100 being the most bullish. We use the score to determine our allocation to growth or defensive assets, and then we select assets on the basis of relative strength. You can see examples of growth assets and defensive assets in the arrows below. We construct our portfolios using ETFs as the building blocks. ETFs allow us to invest in diversified baskets of stocks, bonds, commodities, or other asset classes. This may look like a busy chart, but it's easy to understand. You can see the S&P 500 is the red line underscored here at the right side of the chart. Most of the ETFs used in this example, including the regional banking sector, the NASDAQ Power Shares or the QQQ, energy, financials, cyclicals, aerospace, and the Dow Jones Industrial, are outperforming the S&P 500, while industrials and materials, shown in blue and black here, are underperforming the S&P 500. This is just an example of how to compare the relative strength of a particular sector to the S&P. Fundamental analysis is another useful tool in our toolbox that we often use in the process of sector selection. As we've shown throughout the presentation, any method of analysis is ultimately reflected in price. At the end of the day, you'll be evaluating the performance of your portfolio based on price, and that means you'll be evaluating us by the change in price of your investments as well. We go into next week with the knowledge our model provides on probable investment outcomes and a plan in place to preserve capital should those probabilities change. The information in this video cannot address the specific investment objectives, financial situation, or particular needs of any viewer. The information presented is solely for informational purposes and is not a solicitation or offer to buy or sell any security or financial instrument. None of the information in this video should be taken as investment advice. Any opinions expressed in this video are subject to change without notice. Caliber Capital Management, LLC, or KCM, is not under any obligation to update or keep the information contained in this video current. KCM, its officers, employees, or clients may have an interest in the securities, related securities, or derivatives of the securities referred to in this video. KCM accepts no liability whatsoever from any loss or damage of any kind arising out of the use of all or any part of this material. KCM recommends that you consult with a licensed and qualified professional before undertaking any investment decision.